Good morning, everyone. In today's episode of Commodities and Currency Monitor, we have with us Ms. Riya Singh, who covers the segments. So, Riya, what's your outlook on currency markets?
So, talking about the currency strength, I think dollar index is getting hammered because market is on a path of factoring in the Fed rate cut. And if you look at how the Fed has commenced the rate cut with a 50 bips, they have played right into those sentiments. And even if you look at the numbers that have been coming out from the US, the consumer confidence, which have been another trigger for dollar index to go below 101 and to a low of 100.28 and so. And so apart from that, a lot of weekly data which are coming in. So they are also getting factored into those sentiments. And there have been a lot of speeches from Fed representatives and they have been extremely hawkish. So everything is getting, factored into the sentiment which is floating in the market that the Fed will turn quite dovish on their policy stand. So I think this is one of the major reason why we are getting so much dollar weakness currently into the market. Apart from that, the other currencies like Japanese yen. So since Bank of Japan resumed, or changed its stand with respect to its monetary policy, where they went from ultra accommodative to starting the rate hike, even if it is from from 10 bips to and so forth, but still it is a step forward towards what they were doing from past such a long time. So I think this is also playing into the pressure that dollar index is currently going on. Shifting towards pound and euro, both are currently riding the dollar weakness. Pound is the UK economy has posted inflation numbers at around 3.1%, which is indicating that the inflation is still very sticky, and there is again some pause into the policies required to get it towards 2%. So Bank of England will probably go for a pause for some time until some improvement is seen on that part. So this will be a very favorable thing for the pound, and it will work for the pound. As far as the economic numbers, it is to the tune of recovery, but we are still to see a brighter picture. Coming to the euro is completely driving the greenback because the numbers are not good. Inflation is down, but the economic recovery is still yet to be seen. Rate cuts are happening, and I think it will take some time to get it properly into the economic clockworks and everything. So I think for euro there is a lack of economic recovery evidence, but as long as dollar remains under pressure, it will aid into the euro at least being supportive for some time. For Indian rupee, it is a completely different scenario. Apart from the rate cuts which we are anticipating into the next RBI meeting in October. So I think apart from that, we are good on the economic recovery. We are doing well as compared to the other economies. FII inflows have started to resume on a good side, and I think the dollar weakness is again a plus point. Apart from that, we are an import, crude oil. We import quite a bit of crude oil. We are dependent on that. So crude oil prices has also been, very stagnant for some time. And this is all, it is a very favorable environment that is getting created for Indian rupee. And this is one of the reasons why I've seen such a good dip, but it is unable to sustain it because if you look at the other picture is we are building up the reserves. RBI has been constantly on the path where they are building in a safety net so that if any such uncertainties like we have seen in the past arises, we are on the safer side. So we are at an all-time high with respect to the Forex reserves. So I think whenever there is a dip into the or whenever we see a good appreciation into the Indian rupee, RBI is taking that as an opportunity to get the reserve back high. 83.55 is something that is taken as the base for the Indian rupee, and going forward, I think 84.12, 83.55 is the range that it will be maintained.
Sounds good. Sounds good for India. So my next question would be Forex reserves at record high. How do you see this impacting USD-INR pair? I think you answered the question earlier, but would you like to weigh in anything else on that?
So I think it is a good point that we are building up the Forex reserves, not in just terms of dollar, but also in terms of gold reserves. And it will have it will play an upper hand going forward whenever there is such uncertainties that could arise. And I think the RBI has a target of 1 trillion. We are around $698 billion in the Forex reserve. RBI has set a target of at least achieving $1 trillion going forward, and as long as we see a positive inflow coming in into the market, RBI will be a step in to absorb that flow and work towards that target. And I think even to maintain a competitiveness into the market with respect to the other countries, I think going forward, this is where I'm seeing 83.55, 84.12, that will be the range. Below that, I think the only way I'm seeing it coming below 83.55 is if the interest rate, the spread widens between the Fed and the Indian market. So at the start, where we were at around 100 bips, where Fed was at 5.5, we were at 6.5. But if this rate cut happens and we do come at around 3 and Fed comes at around 3 and we even take it to around 5, I think this will give a good spread between both the countries to start to actually boost the FII inflows. So at that time, if RBI can let the rupee appreciate as side by side, also let work steadily towards it, towards achieving the target, we will see some appreciation. But right now I think 83.55 is the base.
Perfect. So de-dollarization has been the buzzword. I'll restart. So de-dollarization has been a buzzword. How do you think that USD will tackle these challenges?
I think since the Russia-Ukraine war broke and US went with the blocking of the Moscow's reserves, which were in dollar denomination, it has spooked the countries worldwide to at least find some alternative to the US dollar. But I think it is a good idea, and but I think for now greenback is here to stay, because firstly, if you see post what after they put after they blocked off the Moscow reserves, Russia did start to accept payments into the Chinese Chinese currencies for its oil trade. But then there is also a scenario: what is the demand with respect to that when Russia trades with other countries, whether Chinese currency will be able to fulfill the requirement and payments for the Russia and so forth. So I think all world has got used to the stable trading scenario that the dollar provides right now, and finding an alternative is still in the works. Now we did see BRICS coming in and talking about they held multiple meetings and tried to work out the alternatives. So I think if I am thinking about an alternative, what will be the alternative? Because if we do come out or if we do pass on the the power to other currency, it will also mean passing on the dominance, the monetary dominance, the the economic power that the US holds to another country. And I think no country will come to an agreement to that, because everybody wants to become an economic power. So I think that scenario is not is out of the question. Secondly is will they again shift back to the gold standards? But we have seen the repercussions of what happens, because too much demand, not enough supply, it broke off the gold standard. Then the third is again, can something happen in line with what we have seen with the euro, with the EU zone coming together and coming out with a unified currencies. But if we already have that, and right now the rising power is in Asian countries, so there is not so for them to work together collectively, putting their differences aside, putting their interest aside, I think it is still difficult, or it will require quite a bit of time for them to get agreed on towards or working towards this particular scenario. So I think for now, greenback is here to stay. We will see. There is something that has happened post the Russia-Ukraine war is we are seeing a shift towards central banks pushing their gold reserves. So that is happening, where they have cut off. It is very minutely happening, where they have taken a step back from the exposure into the dollar. So a lot of countries who are invested into the US dominated bonds and so forth. But there have been, slowly some move where they have stepped back from those and started, increasing their gold reserve. But I think whenever it comes to trade, greenback is here to stay, and it will take not some time. I think it will take a long time, and a very heartful thinking and a very good alternative to replace the greenback, or to provide the same comfort, trade comfortness that the dollar has provided for so long.
So gold prices have been skyrocketing, and what are the factors driving this? And do you think the momentum will continue?
So firstly, the momentum was led by central bank heavily purchasing gold, and after that, the sentiment of where the Fed will turn very dovish with the rate cuts, and they going forward with the 50 rate cuts, it just ignited that candle that there will be a massive rate cut that will be coming from the Fed side, and the loosening of the policy, the idea of loosening of the policy getting factored into the market is something which is driving the gold prices higher. Apart from that, I think the geopolitical tension is still coming with the Israel and Middle East war escalating to beyond boundaries of just Gaza, and spilling over to Lebanon and Iran. So I think this escalation has also been a part of dollar prices rallying so much. And when if you compare the current scenario with the past scenarios, where any such uncertainties which have happened, the market have been able to bounce back. But right now, what has happened is, once the pandemic fear was removed from the market, there is still some or the other uncertainties that is still prevailing in the market, which is fueling into the safe haven demand, that there is the risk of sentiment has not been able to completely go away from the market. So I think market is slowly shifting and taking a cue from the Fed rate towards where market can go where the safe haven demand can take a seat back. But I think there will always be, because there is still war situation prevailing right now, we will see that gold will continue to rally, maybe not at such a faster pace once the Fed reaches the pause, but I think until then you will see market continue to rally. 2600 has become the new base, and I think profit taking will only happens beyond that. But what we are seeing is $2,800 target to in FY25.
In commodities, crude is also likely to remain subdued as alternative fuels rise. So, do you think the de-crude trend will stay on, or will it bounce back?
I think for the crude prices to bounce back, the demand needs to get revived. There have been, especially in China. So China and India are the other two countries which drive demand, and there needs to be demand a revival, especially in China. There have been a lot of policies that have recently been announced towards reviving the same thing. But I think until the demand revives for the crude, the prices will remain subdued. If you look at the current announcement or some statements that have come from the OPEC, is where they have given up on the idea where the crude will again test back $200, or where they were saying that the prices would average at around those levels. So I think going forward, 75 should be the average for the crude oil prices. And as far as the de-crude trend is considered, I think green energy is the need of the hour, considering all the climatic changes and the repercussions that is happening because of that. But we also need to consider that the transition from the fossil fuel to the green energy is a very expensive one. It requires heavy investment. It requires a continued government support, and only then where we will see a pickup into this energy transition. And also the question remains how clean the clean energy is, whether it is coming from, if it is coming from an actual clean source. So I think the de-crude will happen, but it will be on a more paced form, because it is an option that is only viable right now for the countries which can afford such heavy investment. So I think it will be in a paced form.
Investors have been bullish on Indian equities with manufacturing on a high. How do you see commodities moving?
Yes, so Indian equities have been have been attracting a lot of investors. They are doing very well as compared to the other capital economies. But for the commodities, for the commodities to revive, I think we need to see a revival into the demand. So as far as manufacturing numbers are concerned, we are good on that part. We are actually trading above the benchmark of 50. So I think if more countries adapt to this China one policy, where we will see that China plus one means seeing another country as a plus one, where manufacturing can be shifted. We have seen a lot of manufacturing getting started also in India, where from the most type iPhones manufacturing to solar, even we are very heavily working towards getting everything manufactured with respect to the solar panels also in India. So I think if this trend continues, we will definitely see a good it will definitely be a positive thing for the India, and also for the metals, because if for the metals, as for the commodities to revive, especially in metals, the manufacturing needs to be revived or improved overall. So it just not in India, but also in China, also in Europe, also in US. So I think once the policy loosens out in these countries, and we will see the borrowing expense coming down, because high rates mean the borrowing becomes very expensive. So once the rates come down, I think this would initiate low borrowing cost, more liquidity into the market, and then we will see some the commodities, especially the metals, rallying going forward. I think with the new policies that have come into the picture with respect to the China, we'll start to see some revival. I think copper has already rallied with respect to the recent policy announcements. So I think once the demand picks up, then we will see metals rallying in the coming days.
Sounds good. So we'll commence with our rapid fire round. Are you ready?
Yes.
So I'll name a commodity, and you have to tell me what do you think about it in probably few sentences.
Okay.
Okay. So gold.
Gold always shines brighter, because I think it will continue to rally. Like I said, 2800 is what we are seeing in FY25, and this target may be achieved more. The timeline may be accelerated if Fed goes with a hawkish with a dovish stand, what the market is anticipating with the massive rate cuts and going forward. But yes, I think the rally is not yet done, and it can go even higher
Silver.
towards 2800.
Silver
Is a safe haven, but it is also an industrial metal, and if the policy loosens out and the industrial demand picks up, we will definitely see silver also performing going forward. 30 to 50 is where it is not being able to get sustained, but we have a target of around testing 34 levels as well once the China is back on track with its demand. So until the industrial demand picks up, silver actually has already performed better than gold. So I think once the industrial demand picks up, the shine of the silver will outshine gold with respect to the price momentum.
Okay. Copper.
Copper prices have been very depressed because inventories have been built up and there is no demand into the market, and it will be a very sluggish recovery when it comes to the copper, and we are still awaiting good numbers from the China market, and because in India, like you said, the manufacturing or the commodities have done better because we have an in-house demand, because we have pushed towards the government has a lot of ongoing projects where we have demand for metals. So I think in-house demand has been able to support the industrial manufacturing companies and so forth. But I think going forward, copper, we will see, if we see some recovery into the economic, we will see it passing and sustaining beyond $10,000 on the LME.
Crude oil?
So crude oil the prices will continue to be depressed because I think it should, we were looking it at, averaging at around $75 per barrel. But looking at the current demand scenario, and also as OPEC has said that which they have hold of the supply until October, but after that they will start to release of the supply, paced way. And I think this will again put a pressure on the crude oil prices because there is already no demand, and increasing the supply will definitely hamper the whole crude oil outlook going forward. Maybe small spook if something happens with respect to the supply, like if the war escalates or there is some barrier where the supply chain gets hampered, only then we will see it accelerating. But till now what we are seeing with respect to the demand and supply, crude oil remains depressed in a short term.
Okay. So thanks, Riya. That's it for today's episode of Commodities and Currency Outlook. Thank you.